Hi, my name is Amar, and welcome to Conversations with Kyle. Kyle's a CPA with Clover Hill, and today we're going to be talking about three things you should strongly consider when we're in a downward trending investment environment. And Kyle, why don't you start us off with number one?
Yeah, so I think, the market going down is obviously unfortunate. We always like it when it's going up, but when it does go down, sometimes there are tax opportunities or ways to kind of take advantage of it or better position yourself going forward. And obviously, I think the obvious um, in this environment is, tax loss harvesting. So if you can take advantage of losers in your portfolio and trigger the losses, you can either use that to offset gains, or when the market eventually or hopefully rebounds, you have some losses sitting there to offset some of the appreciation. And so if you have some in your portfolio that you don't see much upside in anyways, might as well take the tax loss, reinvest the money elsewhere, and use that to offset the appreciation. So
Yeah, and there's a couple of things there that you want to be cognizant of, right? It's like once you sell a security and you're purchasing something similar to it, can't be more than 70% the same. Otherwise, you'll trigger like a wash sale type rule. And I think the other thing that we should probably also mention there is that, you know, long-term losses to offset short-term gains is the ultimate, right? When we look at this tax losses. But in this type of environment where things are trending down, we don't know when things will bounce back up, but when they do, you're going to have to rebalance your portfolio at that point anyways, right? You might as well take some of the losses now to make that rebalance a little bit more tax efficient, if you will.
yeah, that's a good point. Is you can't sell Amazon, buy Amazon right back.
Yeah.
So it has to be a completely different security. So it's more part of a rebalancing rather than triggering phantom losses and then reinvesting back into the exact same security.
Yeah, yeah, I like that one. And number two is Roth conversions. So, like when you're looking at your IRA balances and you're seeing them go down, this is an amazing opportunity to take a company that you like or a index fund that you like and transfer that in terms of shares into a Roth IRA. Now, you may be thinking, well, I can do that any time of the year, but here's the advantage is that you're going to be transferring more shares of that same investment over into a Roth. And then when all that growth will be on the Roth side of the balance sheet. So you're actually paying taxes at a slightly lower dollar amount now. Potentially when there's growth, all that growth is going to be on the tax-free side of your balance sheet. So strongly consider looking at the Roth IRA, Roth conversions as a way to take advantage of a downturn in investments.
Yeah. So I think with a Roth conversion, you're triggering ordinary income, right?
Yep.
And so a traditional IRA, it's not tax-free growth, right? It's tax-deferred growth. And so when you move more over to a Roth, you're positioning yourself to have completely tax-free growth for the rest of your life, rather than tax-deferred growth in a traditional IRA. So
Yeah.
that's something I'm discussing a lot with clients right now. Um, also, if you wanted to take distributions from your retirement account, um, you know, positioning yourself for capital gain growth instead of ordinary income growth is another strategy I've worked on with clients as well. But I think a Roth conversion is your best bet for sure.
Yeah. And if you've been following this channel, we've done a couple investment quick takes, if you will. And we feel that there's more downside volatility still left. And so, maybe you do a portion now and you can do a portion later. You don't have to do it all at once. So that's number two. Number three, gifting shares of securities to family members or children or what have you.
Yeah.
Trust
So
or
yeah.
however you want to do it. Go ahead, Kyle.
Oh, I was just gonna say, just it brings up wealth transfer opportunities, in a down market, because you're paying less in the gift tax, or using less of your gift tax exemption or exclusion, if you're contributing securities in a down market. Also, there's more opportunities, like you said, with a trust, more exotic methods like a GRAT, or something where you're trying to transfer appreciation to your heirs. And so that's another topic for another day. But point being is that there are opportunities in gifting to your kids or to your beneficiaries or heirs when the market is down.
Yeah, you got to be thinking a lot of these people that have significant wealth that's tied up in like Bitcoin and stuff like that. This is a good planning opportunity for those type of people where they can transfer some of those coins when they're suppressed in value, and hopefully, if there is a future for Bitcoin, then all that growth is on the other side of the balance sheet on their children and stuff like that. And that is a conversation topic that you should be having not only with your CPA financial advisor, but also your estate planning attorney to see where you fall within those thresholds for estate tax exemption amounts, and use those to kind of create some guidelines, if you will.
Yeah. So, it's all about, it's a timing. We're talking about timing the market, which we know is, impossible sometimes, but
that's why you do small chunks, and then eventually one or two of those chunks will be spot on, and a couple may be slightly off, but at least you're not trying to catch a falling knife.
But stocks go up, stocks go down. When they go down, it's more likely that they're going to go up, right?
Yeah.
So high level. But hopefully one of those three strategies work for you and your portfolio.
Yeah. And maybe we should end this on, you don't have to have a ton of money for these strategies to make sense, right? So like I've seen Roth conversions as small as $2,000 or $3,000 done incrementally. I've seen tax loss harvesting done within a rebalance of a portfolio. So it's just done by small incremental amounts. And gifting shares, that could be 10, 15 shares of your favorite stock, and that could go to a child who also for them are in a lower tax rate, right? So if they turn around and sell in maybe 2 or 3 years, assuming they file independently and all the other good stuff, that they could be in a lower capital gains threshold bracket versus yourself. So thank you for watching. If you have questions or anything that you'd like to add in terms of comments, please leave them below, and we'll look forward to hearing from you next time. Thank you.
Thanks, Amar. Talk to you soon. Bye-bye.
Bye.